They're using execution prices of the bonds that did trade. They're using changes in interest rates, changes in credit spreads to basically price all the securities within the fund. Now, the bond market is a little bit like the real estate market. When you think about your house, you probably have an appraised value for your house. You have a pretty good indication of what your home is worth by using comparables from the rest of the market, by using maybe some trends, some economic trends for your area. But until you go and list that house on the market and actually find a buyer for it, you may not know exactly where that price is going to clear. And so that's the analogy that I would use for pricing on bonds. So while the bid side is the best estimate of value based on all the actual information, it may, when the bonds actually go to trade, they may deviate from that just from specifics relating to that individual security. So once again, the ETF will trade at a market clearing price that basically forces execution levels on all those bonds in the portfolio. And there's also an element of supply and demand of the ETF out there in the marketplace. Just like with any security, if everyone's trying to buy it, it'll bid the price up, so the price will move up. If everyone's trying to sell the security, it'll move the price down. And so in this way, you'll see the supply and demand of the ETF can drive that pricing and will move the market price within those guardrails. And as we spoke about earlier, probably the biggest driver is just the cost to create shares. And KP is going to go into this in a little bit more detail as well. There's this arbitrage opportunity that goes on. So, for example, if the market price, everyone's buying shares of our ETFs, they get bid up. They start trading at a premium above the NAV that's even above where investors could go out and buy bonds. Investors will then go buy those bonds. Authorized participants, that is broker-dealers who can create and redeem shares, will go buy those bonds, deliver them into the ETF provider, and then new shares are now available to be sold in the market. So it's that cost of share creation, primarily in the form of the bid-offer spread of the securities, that can also drive where the premiums and discounts are. And then we just spoke about this a little bit, so around fixed income market volatility and liquidity. So once again, if a sector is more volatile and less liquid, you'll see larger premiums and discounts, as opposed to a more liquid sector with less volatility. So just remember that the net asset value is always struck on the bid. In volatile markets, sometimes the premiums and discounts can look larger than the average. However, there's plenty of resources available at ETF providers if you're seeing some of these premiums and discounts. So I would recommend that if you do have questions on premiums and discounts within specific funds, always reach out to the fund provider to get more information. And then, of course, this diagram can help. So whenever we're looking at fixed income ETF pricing, if it's a very balanced market, meaning that we're finding buyers and sellers on either side, you'll see the ETFs tend to trade in that blue zone. So that's kind of the midpoint between the bid and offer on the underlying securities. And then once again, if there's strong buying demand, it's going to bid it up, and you'll see that blue zone, which is where people are getting their trades filled, is going to trade more towards the offered side of the market. And vice versa. If people are selling the ETF, it can even trade below its NAV at a discount to the net asset value intraday. So with that, I'd like to pass it over to my colleague KP, and he's going to provide some more information about getting best execution.
All right, thanks, Karen. And with that, let me shift over to fixed income ETF trading and ways to think about best execution. I'll start by defining the ETF capital markets ecosystem and how market makers and authorized participants provide liquidity to investors on exchange. Hopefully, by defining the ETF capital markets ecosystem and the two main liquidity providers, we'll be able to get a framework in which to understand fixed income ETF best execution. All right, let's jump into the ecosystem. Much like any other trading ecosystem, there are investors who are looking to either buy or sell an ETF. And usually, these investors will enlist a broker or a custodian to trade on their behalf. And those brokers typically will go and trade on an exchange, and Karen already talked about the exchange as an organized and transparent venue in which securities are bought and sold. Now, the main liquidity provider on exchange is the market maker. That's the orange box there. And a market maker is a liquidity provider who stands willing to buy and sell ETF shares to help maintain the orderly trading of securities, and in this case, the ETF. The ways market makers are compensated is through the spread of the ETF. And the last thing I want to say about market makers is that for any given ETF, there are typically multiple market makers competing to be the best provider of liquidity. For instance, here at iShares, we have over 250 market makers who are competing to trade our iShares ETFs. However, in some instances, a trade or a series of trades may lead to an imbalance where market makers either have bought too many shares or sold more shares than they can obtain on exchange. This is where the authorized participant, or the AP, comes in. An authorized participant is a broker-dealer, or it could also be a market maker that's authorized to trade directly with the ETF provider. They basically will be able to create or redeem shares of the ETF. Again, Karen mentioned that the net asset value of those ETFs. And then finally, the ETF provider. That's us, iShares. We're a financial institution that sets the investment objectives of an ETF. So let's actually throw an example out there. Let's assume that Karen is actually an investor looking to buy 100,000 shares of HYG. She will enlist her broker, which we've already defined, to go on an exchange and trade on her behalf. Again, an exchange is a venue that provides transparent trading of securities. The person who actually helps that orderly trading of securities is the market maker who supports the orderly trading on exchange. And then there's the authorized participant who stands ready to create new shares when needed, or redeem ETF shares when there's an oversupply on exchange. And finally, again, there's the ETF provider who sets the ETF investment objectives. Before we go on to the next slide, when Karen's looking to trade, she usually will want to ask herself 3 basic best execution questions. First, she'll want to understand at what price should she trade, or what her execution level should be. She'll also want to understand whether ETF is trading relative to its underlying basket, or in other words, what's the prevailing premium or discount relative to the net asset value. And finally, she'll also want to understand when she should trade. These are all important questions to ask. And here at iShares Capital Markets, we're positioned to help our clients understand questions such as those. For instance, we have a capital markets execution services team that provides market insight, product expertise, as well as execution services to our clients in the form of pre- and post-trade analysis. And we also have a broker-dealer team that works with our market makers and authorized participants to broaden and deepen the level of servicing that those broker-dealers and market makers provide to our end clients. All right, so now that we understand the ETF capital markets ecosystem and the roughly 6 participants involved, let's jump into the creation and redemption process. But before we do that, let's quickly recap. So we have Karen, who's looking to buy 100,000 shares of HYG. When Karen is looking to buy the 100,000 shares of HYG, we now understand that a market maker will be the other side of the trade. Now, in some instances, the demand for the ETF might be greater than what the market maker can source on exchange. And so what typically will happen is that the market maker will approach an authorized participant to create the underlying bonds and deliver those in kind to the ETF issuer. Again, that's us, iShares. In turn, we will deliver the ETF shares to the authorized participant in what is called a creation of ETF shares. At that point, the AP will deliver the shares back to the authorized to the market maker, who in turn will provide Karen her shares on exchange. Now, the reverse of that process is called a redemption, and there you just have to switch the arrows around, right? So if Karen had 100,000 shares that she was looking to sell, she would simply give them to the market maker. If the market maker was not able to get rid of them in the on-exchange market, they would go to an authorized participant who would deliver those shares again to us iShares, and we in turn would give the underlying basket to the authorized participant, who most likely would sell the underlying bonds, deliver cash proceeds to the market maker, who then passes it along to Karen. This happens instantaneously and every single day that an ETF is open. So why does this matter to us? Well, as I mentioned early on, an ETF supply and demand on exchange is managed by market makers. If the demand or buyers of an ETF surpasses suppliers or sellers on exchange, a market maker will approach an AP to create new shares in the primary markets. Creations in a fixed income ETF will typically occur when the price of the ETF begins to approximate the cost to buy the underlying securities, which in Karen's example is high yield bonds. Similarly, if the supply, again think sellers, of an ETF are greater than the demanders or investors who are looking to buy, the market maker will approach an AP to redeem shares in the primary markets. Redemptions typically occur when the price of an ETF begins to trade near or below the net asset value of the ETF, which in this case represents the bid or selling price of an underlying bond. Another way to think about this is that the liquidity APs provide to market makers and ETF investors is a function of the cost of the ETF underlying holdings. Effectively, ETF market makers have access to the additional liquidity on a daily basis, and this is a very important distinction between ETFs and single stock securities. An ETF has two forms of liquidity. There are the shares that trade on exchange, and then there are those that can be created and redeemed on a daily basis. All right, so now that we have an understanding of the primary markets and also the secondary market trading of ETFs, let's focus on fixed income ETF best execution. But let's start off by tackling the primary market liquidity layer. If we focus on the left of this slide, we have a line that represents NAV, or the price that an AP will deliver the underlying bonds of an ETF to us, the ETF issuer, in return for ETF shares. NAV acts as a common price basis for both the ETF and its underlying holdings. So in Karen's example, we chose an arbitrary value of $100. This means that when an AP creates new shares of HYG, they'll deliver the ETF bonds at their bid side value of $100 and receive ETF shares at a value of $100. However, for an AP to buy the bonds, he must purchase them on their offered price, or another way to say offered price is the ask of the ETF, of the underlying bonds. So in effect, he has to pay the full spread, which for high yield bonds is around 80 basis points in price terms. This would mean that the NAV of $100, an AP would have to pay 80 cents above that NAV, or a price of roughly $100.80. Now, if we think about it, for equation to be cost-effective in this scenario, the ETF price would have to trade either on or above the offer of the underlying bonds at $100.80. If that happens, an AP will step in and collapse the ETF price back within that upper boundary. Conversely, if supply is greater than demand, or in other words, there are more sellers than buyers, the ETF price will drift to or below the net asset value of $100, which is set by the bid side value of the ETF's underlying bonds. In this instance, the market maker will approach an AP to have them step in and redeem the shares to bring the price back within the lower boundary of $100. Effectively, premiums and discounts provide the boundaries for us to understand where we expect an ETF's price to trade. And this is precisely why we should care about premiums and discounts in an ETF. The premium discount offers us insight into the cost we're paying to gain the underlying exposure. Typically in an ETF, the underlying liquidity will represent the largest layer of liquidity, and in the case of HYG, a conservative estimate pegs this layer at roughly $44 billion on any given day. However, the underlying is also the most expensive layer of liquidity, as it takes time and effort to purchase bonds in an OTC market. Let's put this in perspective. Of the $250 million worth of HYG that trades on any given day, only 15% will ever touch the underlying bond market. In other words, the other 85% of liquidity is provided by market makers and the second layer of liquidity that we'll call non-displayed or hidden liquidity. Non-displayed liquidity represents other investors, including retail, institutional, and broker-dealers who are looking to either buy or sell an ETF shares within the bid or the offer of the ETF underlying bonds. By that I mean non-displayed sellers will always try to sell at a price greater than NAV or the bid side of the ETF underlying bonds, again in this example $100. And similarly, non-displayed buyers will try to buy the ETF cheaper than the upper boundary of $100.80 or the offer side of the ETF underlying bonds. The layer of liquidity is also important as it starts to allow us to see where the market clearing price for an ETF will be, and that's typically within the bid-offer spread of the underlying bonds. Effectively, non-displayed liquidity offers ETF price improvement relative to the underlying holdings. In many respects, non-displayed liquidity is also another large layer of liquidity for an ETF. For instance, roughly half of HYG's $250 million that trades is made up of institutional non-displayed liquidity. All right, let's continue with the HYG example and Karen's purchase. Let's assume that the non-displayed buyers and sellers are fairly evenly split. And so we expect that the market clearing price for an ETF will be somewhere between or around $100.40. But much in the way that the name just explains, non-displayed liquidity providers do not publicly have to provide any insight into the price they're willing to either buy or sell until they actually trade. So to get insight into the ETF market clearing price, we have to look at the last layer of liquidity, and that's displayed liquidity. I'm calling it displayed liquidity since this layer of liquidity is maintained by market makers. Remember, market makers must publicly quote the price they're willing to buy and sell ETFs. They also display how many shares at a given price they're willing to buy and sell. So in this example, a market maker is willing to sell a penny below the market clearing price and buy the ETF shares a penny above, or sells the ETF a penny above the market clearing price. Although market makers may or may not be as large as non-display liquidity providers, and in most instances are not as large as underlying liquidity providers, they are the most important participant as they offer transparency into the market clearing price that all other investors are looking to trade around. So now that we understand all three layers of liquidity in an ETF, and I'm assuming that we're all savvy investors, let's think about the ways in which you can maximize these three layers of liquidity. The best way to tap into the three layers is using a limit order when you trade. A limit order forces market makers to try and find non-displayed or underlying liquidity in the instance that their displayed liquidity is not sufficient. Again, early on I mentioned that at iShares we have over 250 market makers. So in effect, when you put a limit order out there, you're forcing all of those market makers to compete against each other to fill your order. They will fill that order either using displayed liquidity or the non-displayed liquidity, and in some rare instances, they might have to go and create shares using an authorized participant. Now, there are just two basic rules when you're using a limit order. The first is, if your trade is less than 1% of ADV, and ADV is the average daily volume, you'll want to place your limit order at the prevailing bid or offer, or if you're conservative like I am, you might want to put a limit order a penny or two above the offer if you're buying, or a penny or two below the bid if you're selling. Otherwise, if your trade is greater than 1% of the average daily volume of the ETF, you'll want to consult a pre-trade tool, much in the same way as you would with any other securities. Here at iShares, we have capital markets representatives as well as sales representatives that are willing to provide you with pre-trade guidance if you need it. So feel free to reach out to us, or otherwise you can dial 1-800-iShares, and we'd be happy to provide you with pre-trade guidance. But let's go back to the HYG example and Karen. So she's looking to buy 100,000 shares of HYG. This morning I ran our pre-trade tool and ran the 100,000 shares in it and found out that she could execute roughly 2 cents above the prevailing offer. So in this example, that would be a price of $100.43. So the question I guess we have to ask ourselves is, is that a good price? Well, I'll leave that to you, but I want to highlight a couple facts. First and foremost, Karen just bought and gained exposure to 850 bonds in one single trade. Not only that, but she also transacted at 43 basis points relative to the net asset value. Again, let's remember that the average bid-offer spread of the high-yield bonds is 80 basis points. So in effect, Karen just saved 37 basis points, or potentially $37,000 on a $10 million investment. So now that we have an understanding and we've walked through the example, let's think about what you have to be mindful of when you're looking to trade in the fixed income ETF landscape. First and foremost, we just highlighted that you should use limit orders when you try to place your trades. Limit orders force market makers to compete to fill your order. You know, I like to steal the Linden Tree slogan that when market makers compete, you win. All right. So then the other thing that you want to be mindful of is the prevailing premiums and discounts in an ETF. Karen early on mentioned that you can get this information on iShares.com, or else if you have Bloomberg, the NAV screen will actually have that information. What you want to do is look at the historical premiums and discounts of an ETF and figure out what the prevailing premium or discount is relative to those historical norms. One quick and dirty way to do that is to look at yesterday's net asset value and compare it to today's prevailing market price. But I'm going to warn you, you will always want to factor in the 4 drivers of premiums and discounts that Karen alluded to earlier on. Obviously, any market-driven event is going to move the NAV from yesterday to today up or down, depending on what's going on in the marketplace. You'll also want to pay attention to the bid-offer spreads of an ETF, as when you trade along the bid-offer spread, you want to understand kind of where the market clearing price is relative to where you are trading. And then the last piece of advice is that whenever you're trading, you want to kind of avoid the last 30 minutes of the trading day as well as the first 30 minutes of trading. The first 30 minutes of trading is when both the displayed and the non-displayed liquidity tends to be light, as investors and market makers are looking to gauge where the market is going. The last 30 minutes of trading is typically when the underlying bond market tends to dry up, as most bond traders stop trading around 3 p.m. Eastern. So there you have it. Those are the 4 checks that you should put in place before you place any trades. And with that, I hand it over to Oliver.
Thanks, Karen, and thanks, KP. We going to launch into some questions. We have a fair amount of time here, which is nice. It's a luxury that I enjoy having. So any of you who want to answer or ask any questions, again, as I said at the beginning of the presentation, it's on the lower right of your screens, and keep them coming. The more the merrier from where I sit. So let's get right into it. I'm going to ask a question. I think this is related to what you were just on about, KP, with limit orders. You just explained why a limit order works and why a market order may not be an effective ETF trading strategy. And why wouldn't another strategy? You hear about VWAPs sometimes in the trading traffic, certainly in conversations with market makers I've heard that. Why wouldn't that be as effective as a limit order, KP?
Yeah, no, that's a great question, Oliver. I think that like any other strategy, you always have to be mindful of how liquidity is sourced on a security. And for a single stock, obviously a VWAP will work because what you're trying to do is maximize the amount of trading given the trade profile of the security, right? So, for example, most stocks will have the highest level of liquidity at the close of trading.
Can you take a step back, KP, and sort of walk the audience a little bit through what a VWAP, how it works, in fact, in case anyone's not totally clear on that, please?
No, definitely. Actually, let me define a VWAP. So a VWAP stands for volume-weighted average price. So effectively, that strategy implies that you'll try to capture liquidity given the trading profile of the security. So if it trades very heavily, you'll always want to try to maximize it when it trades the most versus when it's thinly traded, right? And so for a lot of single stocks, you tend to find that the closing price or the closing session is when they trade the highest. And so a VWAP strategy would imply that you probably trade the most then, right? But again, when we're talking about the liquidity layers in an ETF, there's the displayed, the non-displayed, as well as the underlying. And so what you want to do with the limit order is that you actually effectively put in the market maker to work for you, right? And what you're saying is that I'm not willing to pay any more for the ETF because I realize that there are non-displayed liquidity investors out there who are also buying and selling the ETF at prices that are better than the underlying securities, right? So effectively, a limit order is the strategy that typically works for the vast majority of ETF trades.
Great, thanks, KP. You talked about HYG. Yes, the high yield market is relatively illiquid compared to, say, the Treasuries market, but that said, HYG is a liquid ETF, and you made the case that limit orders are very sensible in that particular security. Now, do they also work on less liquid ETFs?
Yeah, no, definitely. Early on you had mentioned that we came out with a couple short-term products. So if we were to look at a product like NIER, which is our short-duration active fund, what you want to notice about that fund is that although it might not look as if the displayed liquidity is that deep, if you were to look at how much there is in terms of non-displayed liquidity, there's roughly $100 million out there. So effectively, the limit order will still work. What you want to do, again, like I said, is that you want market makers to actually source that non-displayed liquidity on your behalf, right? So by placing a limit order, hopefully you can achieve that.
Okay, thanks. Now, you talked about this single stock pre-trade tool. How effective are they for trading ETFs for those who aren't familiar with their use intimately? Yeah,
so that's a great question. One of the issues that we've seen with single stock ETF pre-trade single stock pre-trades is that they don't capture the underlying liquidity sources for an ETF. So here at iShares, we've actually built out a pre-trade tool that's mindful of the different liquidity buckets. So we're looking at the displayed, the non-displayed, as well as the underlying to effectively harness the total liquidity of an ETF, right? But in some single stock pre-trades, what tends to happen is that they're only looking at the displayed liquidity level, And so you might end up trading away from where you should. And that's exactly why, if you don't have an ETF-specific pre-trade tool, you should reach out to your ETF provider to get some insight into ways in which you should trade your investments.
Okay, thanks. Now, one sort of final, more simple one, because there's a lot of really high-quality questions coming in here from the audience that are rather granular. Just for clarity's sake, when a fixed income ETF is trading at a discount to NAV, is it fair to say it's trading on sale to some extent, or is that the wrong way to look at it?
That's a question that we get pretty frequently, because when investors are observing premiums, they understand, well, that's a lot of it's driven by the transaction costs associated with buying bonds. When it's trading below the NAV, look, I can buy something that's on sale. Well, you always have to ask yourself, is there something going on? Is there stress in that part of the bond market that's making it more expensive, or you're trading bonds below where the prevailing bid levels are? So traditionally what we see is during periods of stress, so when people are selling out of the asset class, and this has happened quite frequently within municipal bond ETFs as well as high yield ETFs, the ETF will actually act as a indicator of where the market's going. So it's imputing that information much more quickly, and it takes a couple days for those bid prices to catch up with the ETF price. So that's one thing that we notice is it leads the market in those instances, and it's really showing you where bonds are trading given that there's a lot of selling pressure going on. So whenever you do see a discount on the ETF, it doesn't necessarily mean that it's on sale. It might mean that there's just a lot of stress on that part of the market, and trades are clearing below where yesterday's bid was. So if you think about NAV, it's only struck at the end of each trading day. So whenever I'm referencing NAV today, I'm having to look at the closing prices of last night. So the trading price of the ETF might be showing you some new sentiment that's going on in that marketplace today. And once again, that's a situation like KP mentioned where an ETF provider can help offer you some guidance on flows they're seeing in the sector, what's going on in the underlying, et cetera. And they're going to have a lot of that information to help you identify, is this actually an opportunity to buy something on sale, or is the ETF market price just telling you that bonds are going to be trading down the next few days?
Got it. Thanks, Karen. Now, you had just talked about, you had echoed a little bit what I said in my introduction on my Columbus Day example, where essentially you have an ETF market that is, it's open, and the underlying bond market essentially is not. So the ETF market is playing some kind of a leading role here. And your example, it sounded like a very virtuous scenario, where you can sort of, in some sense, trust what the ETF market is telling you relative to what the underlying are going to price when things settle down. Now, that said, when is that an unsafe or an unwise assumption to make, and when might it be more sensible, limit orders notwithstanding, to just back up and just let the market do what it does before you ever step in there to transact? And that's a bond market specific question, even though one could also say the same thing about stocks. I'm talking very specifically about bonds, of course.
Of course, it depends on your investment goals, objectives, your time horizon. So it would be interesting to say that if you're contemplating exiting a sector, I think one of the best things about using an ETF to get that exposure is that when you did want to sell, you can go to the exchange, and yes, you might be trading at a discount to last night's NAV, but you can go out and get that trade done. I think if you're holding a basket of, let's say, individual muni bonds, and you go to your broker and say, I have 10 muni bonds, I need to sell these now, I'm wanting to get out of munis, I no longer want that exposure, it might take them several days or even weeks to find a buyer on the other side and to work that order for you. So I think that if you did want to reduce a position and you're using a fixed income ETF to do that, at least we have the exchange behind us and you can source liquidity on the exchange as opposed to having to go out to the over-the-counter marketplace. So I think that is one of the biggest benefits of the ETF, is that they do create liquidity. They do create the ability to trade when you want to trade and not have to wait to find a negotiated buyer on the other side.
Okay. Now, sort of a related question. I've heard some people say, you know what, this divergence from NAV, whether it's a premium or a discount in the world of ETFs, you know, given the, call it the dark side of intraday trading, if you will, with regards to bond ETFs, I've heard some people say, you know what, I'll just go with an open-end mutual fund because I get NAV at the end of the day, and I don't have to stress out about how to negotiate those perilous straits. What's wrong with that kind of thinking? And you think that's a little oversimplistic, or is there something to that view?
I would say that is a common concern and complaint that when we speak with investors. many of them are used to using mutual funds, and so they're saying, why would I go through these complexities of trying to understand these premiums and discounts when I know I can get in and out at NAV in my mutual fund? Well, here's just the example that KP was using with buying these high-yield bonds. So mutual funds are mutual in every sense of the word, and I'm not going to say anything negative about mutual funds because BlackRock is a big mutual fund sponsor as well. But when you think about mutual funds, those costs associated with buying and selling securities are mutual, so meaning that all investors share in them at the same time. So here's the example that KP was using. If a new investor wanted to come into a mutual fund, the portfolio manager of that mutual fund would go out and purchase underlying bonds to fulfill that order. And they would be trafficking in the over-the-counter bond markets, and they'd be paying, as KP was saying, about 80 cents for that order. So within a fixed income ETF, if you're trading in the secondary market on the exchange and you're able to match buyers and sellers and not have to go out and touch the bond markets, so we're only going to be paying, in this example, it was 43 cents for the cost of buying those securities. So while you did pay more than NAV, your cost is isolated. So that way when the next person gets into the fund, you're not having to share those costs. You've only paid your freight and you're not paying for anyone else's. And I think it's really this isolating the transaction costs is the fact that you're not impacted by other investors. And that's just one of the value propositions of fixed income ETFs, is that while your trading costs are going to be very explicit, at least you know what they are, and going forward you're not going to be paying the costs of other investors trying to get into that fund.
Yeah, that sounds like a virtue of the ETF wrapper in a general sense that transcends the fixed income space, but I hear what you're saying. I take your point there. Let's see now, kind of a mechanistic question here coming from the audience, and this is a good one because you kind of wonder, how does this really work, this ETF creation redemption process? Does this process happen literally instantaneously? Is it done electronically, over the phone? I think it's sort of almost feels Wizard of Oz-ish sometimes when people contemplate this. Can you touch on that a little bit?
Yeah, usually an ETF provider will have a agent that takes creations and redemptions on their behalf. And so it does happen instantaneously throughout the day. So if market makers are making markets on exchange and they realize any imbalances, they'll call in the creation into that ETF issuer. And effectively at that point, then the market maker or authorized participant and whoever is creating will actually receive those shares at the net asset value for that day's trading.
And so the only thing that I would add to that is you could see a market maker or an authorized participant that wants to create shares of the ETF, and let's say in the case of the bond markets, they might be sourcing those bonds over a couple of days. Then once they have the bonds, they can deliver them into iShares, and that's when the creation happens. So it kind of depends on how the business model is set up, and it depends on how quickly the securities can be sourced. If you think about, once again, our S&P 500 ETF example, that's pretty much electronic, instantaneously, whereas within the bond market, depending on the counterparty, they could round up all those bonds in a very short period of time and deliver them in, or it might take them a little longer on their end to source the securities. So from our point of view, it's really an inventory management that the broker-dealers have to do within not only ETF shares themselves, but within the underlying securities.
Right, and I guess like even to add on top of that is the idea that obviously the majority of authorized participants are broker-dealers, and effectively a lot of them have a balance sheet of bonds, and so they are monitoring what's happening in the secondary market, and when they see that there is a need to either create or redeem, they'll source their underlying bonds that they hold on their balance sheet, right, and so that could happen instantaneously.
Right. Now, I wanted to piggyback on your comment about LendingTree, KP, getting market makers on your side. I've heard market makers speak to this as well. Listen, if they encounter someone who knows what they're doing in the traffic, they're going to be on their best behavior. They're not going to be, trying to get the better of someone who doesn't know what they're doing. So my question is, give us a sense of what is that process? What does that look like? Is that a lot of homework, or you got someone doing it for you in the traffic who's got a big Rolodex who can get all these people on board? It's obviously there's some logistics involved. Are there not?
So in terms of the client understanding where they should execute?
Yeah, and how you get market makers on your side. So in effect, they are looking to make create a convergence between the bid-ask spread so you get good execution, as opposed to, being on totally the wrong side of that bid-ask spread and it widens out because of, your possible ignorance of the matter,
Yeah, exactly. And so that's why we were saying that, using limit orders is usually the best strategy when you're placing orders out there, because if you put a simple market order, right, the market maker will realize that you probably are unaware of the non-displayed or the underlying liquidity sources of an ETF, and effectively they'll push that market price, in the case of a buy, towards and beyond potentially the natural premium, or in the case of a sell, be towards the NAV or below the net asset value of the underlying securities. So in terms of your question, again, we had those two rules where if you're less than 1% of the ADV, you should be mindful of what the spread is of the ETF. But, if you think that, like, for example, in HYG, it tends to trade a penny wide, you could put that order on the offer or the bid, and you should get filled. And if it's anything larger, that's why we're saying we should consult a pre-trade tool. And again, you could go to your ETF issuer to understand what pre-trade guidance you would need in that instance. And so we stand on the same side as our clients to help them navigate how to trade, if they have any concerns. And I guess like the last point I want to make on that is that obviously you shouldn't necessarily be the person who's trying to do all the work. That's what the market maker is out there for, right? And so by putting that limit order out there, you have to make them think about where I'm going to source the liquidity. It's not necessarily up to us to do that.
Got it. Now, at the risk of making you repeat yourself, KP, we have a very specific question here from the audience. Where should that limit order be in the bid-ask range? And I think you touched on a couple of contingencies there, but is that an easy question to answer, or is the devil in the details there?
Yeah, I mean, it definitely depends on the actual ETF and its trading dynamics. But, again, like we said, if you are less than 1% ADV, you're going to try to trade up, and if you want to be conservative, you could put it above the offer, a penny or two or so, or below the bid. And on larger, more complex trades, you will want to understand kind of what the liquidity looks like on average, right? So in the case of HYG early on, I mentioned that institutional investors tend to make up roughly half of the flow there. So on larger trades, we have seen them, executed a couple pennies above the offer or below the bid, and that's why you'd want to consult the pre-trade tool.
And I would just add to that quickly. So whenever you're looking at very liquid, large fixed income ETFs like the ones we cited, LQD, HYG, there's a lot of two-way flow in those. So if you're putting in a limit order kind of at the midpoint or right around the bid-ask, there's only going to be, traditionally it's a penny or two, so you're going to get filled within that really tight range. Now, where clients have the most questions tend to be around less liquid or newer ETFs. So because they haven't built up that robust two-way market yet, traditionally what we tend to see is market makers may be putting out wider bid-ask spreads because of the cost associated with carrying that on their inventory. But that doesn't necessarily mean that you're always going to get filled at the bid-ask spread, having to pay above that ask. Sometimes you can get filled at the mid, kind of in between the two. So that's something to ask yourself, is it a large liquid ETF? How much flow is there? Once again, the reference point should always be the bid offer of the underlying. Are they pricing it in between those two numbers? And then can I get improvement basically versus a displayed liquidity by putting in an order somewhere in the midpoint? So I think there's a lot of questions you need to ask yourself about that particular ETF and how liquid it is in terms of just the trading volume. And then as KP pointed out, where are the market makers putting that bid-ask spread? Can you get improvement there by putting a limit order in maybe more towards the mid side?
Got it. Now, here's another good question from the audience. Can you touch on why you wouldn't want to trade at the open or near the end of the trading day? Can you execute with market on close orders as you might do in the equities realm?
Yeah, so, on some liquid ETFs, yeah, you can trade within the first and last 30 minutes. However, just as a general rule, what I alluded to early on, at the first 30 minutes of trading, typically what ends up happening is that market makers are looking to see where the market's going to be going in an ETF, obviously because what they're gauging is what's happening with the underlying securities held in that ETF, and that's going to dictate where the fair value of the ETF lies, right? So, in terms of trade profiles, for a single stock security, the largest liquidity buckets tend to be at the beginning of trading and at the close of trading. However, in an ETF, it actually happens intraday, right? So the way in which I think about it is a single stock usually has a profile that looks U-shaped, whereas an ETF typically has a dome-shaped liquidity profile, right? And so by maximizing the liquidity, you'll always want to trade intraday rather than trading at the open or the close. And again, the reasons are for the close is that the bond market tends to dry up then. And so if a large trade goes out there on closer to the close, a market maker is left without the underlying liquidity source in which to tap into.
That's a really great.
Go ahead.
I was just going to add, that's a really great point about the bond markets being closed. So that's right, at 3 p.m. Eastern is when most bond market participants close up for the day because they need to start marking their positions and settling securities. So it's that last hour of the day where the stock market is open, the ETFs are trading, they are serving as those price discovery tools. But if you're looking to put in particularly a large order, the authorized participants cannot go and buy bonds at that point in the day. So that's when you tend to see maybe wider bid-ask spreads. You tend to get, I'd say, poorer execution. So it's just something to keep in mind, not only for fixed income ETFs, but also for equity ETFs, particularly on the international side. So you've got to ask yourself, are the international markets open? Are they closed? So we have some fixed income ETFs, for example, local currency emerging market bonds that primarily trade in other regions. Or we have a European high yield fund where Europe is open at the beginning of the trading day. So the first hour and a half of the day, that's the best time to execute for that fund. So you've always got to ask yourself, are the underlying markets open? If the answer is yes, then that underlying basket liquidity can be sourced. If it cannot, that's when you can see worse execution.
Got it. Now, we're coming here to the end of our time. I think we have one more question. Here's from the audience. You talked about international markets. How about illiquid international markets? What steps have been taken to avoid NAV mismatches in the less liquid fixed income areas, emerging markets? Certainly that happened earlier this year. Any concrete measures that have been taken that might minimize this issue?
Yeah, we always want to consider whenever we're constructing an ETF or whenever we're selecting an index and the index rules, we want to make sure that not only do we have good securities pricing, so is the source going to be accurate, but is there going to be any liquidity concerns with creating or redeeming shares? So I'd say the biggest instance in international markets where we have issues related to this is when there's market holidays that don't correspond with the U.S. market calendar. So we may see this where there's different holidays in Asia or Europe, for example. So on those particular days, and the ETF is still trading, it might take a few days for a creation to take place simply because they cannot go out and buy the underlying bonds. And so that's just something else to note that we're very aware of when orders are coming in, and that's really up to us to not only help the APs understand the contingencies there, but we want to make sure we're constructing an ETF that considers all of those holiday calendars, for example.
Great. Well, that about uses up all our time. Thanks for joining us on this Expert Series webinar, Fixed Income ETFs, Navigating Today's Trading Environment. KP and Karen, thanks for being my guests. And I also want to thank the audience for attending and also for some very good questions. Again, as I said earlier, the presentation will be available to all of you by early next week, and you'll receive instructions on how to obtain it in an email. Additionally, if this fixed income discussion has been stimulating, IndexUniverse is hosting an Inside Fixed Income conference tomorrow in San Francisco. It's held at the Grand Hyatt on Stockton Street if you are in San Francisco. On that note, on behalf of Karen and KP, my guests from BlackRock, as well as all my colleagues here at IndexUniverse, I'm Ollie Ludwig, wishing you all a very pleasant afternoon.